Hey everyone, welcome to Solving the Riddle, the podcast that unpacks the financial puzzles shaping your future. I'm Andrew Whitewood, and together with Alec Riddle, we explore the ideas, behaviors, and strategies that help people make smarter financial decisions and build lasting wealth.
Right, good day everybody, and welcome back to another episode of Solving the Riddle. This is episode 3. Very encouraged by the response to our first 2 editions. Andrew and I are highly motivated to continue with this and to build it into the industry and become hopefully one of the leading financial planning podcasts in South Africa. To do that, we'll need your support, so please don't forget to like, comment, and subscribe. That'll be really help us a great deal. So today we're going to be unpacking hedge funds. This is something that's become an integral part of financial planning, relatively new to many of us. I'm sure new to many of our viewers and listeners, and we'll try and keep it as simple as possible. And to do that, not only have we got Andrew Whitewood with me, but we've also got an expert from Peregrine Capital, Waldo Booysen. And Waldo, maybe you can tell us just a little bit about yourself, first of all on the personal side, and then you can weave into the business side.
Yeah, so Alec, I live in a quaint little town called Stellenbosch. I'm married. I like a bit of mountain biking. I like, let's say, hit training. So yeah, it's an interesting, let's say, combination with me being your sales guy, because I know of your history. So yes, that's what I do when I don't work. I think in terms of this industry, I've been in it for around 14 years now, most of it on the sales side. I started off as a Lisp guy, platform guy actually, and then moved into advice, and then I moved over to Peregrine, and that's how I got to know you guys, where I work as an investment specialist now. So I've been the guy that's been telling Alec and Andrew about the hedge funds, and that's why I'm sitting here today.
Yeah, and Andrew, I think Waldo has done a good job of helping upskill us in terms of hedge funds, together with other hedge fund managers and people we've met. But perhaps you want to come in and just touch a little bit on what we're talking about today.
Yeah, thank you, Alec. I think the key thing is, Waldo, it has been a journey, right? Together, we got exposed to hedge funds probably a couple of years ago, Alec. And it was daunting for Alec and I too, from a financial planning point of view. But the key thing that Alec and I have spoken to and about in the first 2 episodes of the podcast is things are always evolving, right? And we're keen to learn. I think that's the key thing for us today, is to unpack hedge funds, give a little bit more information, put people's mind at ease, but also understand how a hedge fund can be used within a current or future investment portfolio, Alec.
I think the other thing that's also important for our listeners and viewers to know is that it's a highly regulated space. So, for example, when I first learned about hedge funds, which are available on all of the major platforms, from Alan Gray to Old Mutual Wealth, Momentum, etc., I couldn't just go and pick a hedge fund and use a hedge fund. We first of all, from a business point of view, I remember speaking to you about it, private wealth management, had to go and do some due diligence, like all of the other companies, on companies like Peregrine and other hedge fund companies. But even then, when it became an approved product on our platform, I couldn't use hedge funds because I had to basically go back to university. And I had to study again and write exams to become qualified. So only then, and in fact, I'm still under supervision, I think. Are you my supervisor?
I am actually your supervisor still, Alec.
How the wheels turned. 16 years ago, I was your supervisor. But anyway, yeah, so I think it's important that people realize that, you can't just go and pick something because you like it. You have to have great knowledge. You have to learn. You have to show that you're qualified and experienced and so forth. And Waldo, maybe you can just come in here and talk a little bit about the sort of compliance, the regulation, the legislation, etc.
Yeah, yes, Alec. I think back in the day, the first perception of hedge funds out there was it was for wealthy people. Our one fund was launched in 1998, other one was launched in 2000.
And sorry, can I just mention, that was for institutional funds only?
Yeah, awful. Yeah, so it was, let's say, it was a locked out kind of product for most of the people that's listening now. Whereas we're sitting in a current situation of you can access the funds for the minimum debit order that you guys have via the platforms. And the nuances when it comes to new products, I'll always move back. And I think I've mentioned this to you previously. Like, the first unit trust in South Africa was the Sage unit trust. That was launched in the 60s. It got absorbed numerous times. You won't be able to find it now. But before that, it was only life funds. And then unit trust came to the fore more aggressively, let's say, in the 90s. And the same started to apply with us, where legislation changed, where advisors could start accessing hedge funds. But then you needed product that was retailed, wasn't available. And we were one of the first guys to bring retail hedge funds to the fore to advisors. But then there was another hurdle. Guys needed to have licensing. So not all advisors are licensed to make use of hedge funds. And that's where it gets quite funky, because if you think about this, you need to be a specialist investment advisor to be able to offer this to your clients. As mentioned, you need to go through a lot of training programs. I think you've gone through our videos that we gave to you guys, where you need to log this. It's a 2-year process where you need to go through this. So it's not something that just happens overnight. A run-of-the-mill advisor can't just walk out from the street and say, listen, I want to sell this to my clients. And this is where it gets to, the gist of it, where hedge funds are complicated products when you don't understand them correctly. And this is where I got to know you guys. This is how we actually built a relationship from Peregrine and PWM, where it is an ongoing relationship now. This isn't something that's getting flogged down to the client. There's a specific need for the product, and you guys use it for that.
And Waldo, if I could just step in, and thank you, Alec. The key thing from a private wealth management point of view is that we are very strict with regards to the supervision process. That subcategory we know is 1.26. So I just want to add that point, that it's not every single financial planner out there that, number one, can advise on hedge funds, but then number two, from a business point of view, which we find a lot of comfort in, Alec, is that we've got this framework, this regulatory compliance framework, where we guided, like you say, you referred to these videos, we've partnered with the likes of Peregrine and other managers out there and partners that are helping us on this journey. It is a long process, it's 2 years, but once again, Alec and I are always willing to learn, take the time out of our diaries to partner with the likes of Peregrine Capital to almost enhance, or most definitely enhance our offering to clients.
Yeah, great. I don't want to go down too much the compliance route, because otherwise we're going to lose some of our listeners. So come back in, because what I want to do is I want to hand over to Waldo and ask you, perhaps let's just use a simple example that everybody can relate to. I'm thinking of the Capitec ABSA situation. Perhaps you can just enlighten our viewers and listeners about that.
So something that hedge funds do that are very unique to them, and it's called the pair trade. What that means is I go long one share. Normal funds can do that. Anybody can do it. You can buy it via your direct share trading platform. So let's say I wanted to buy Capitec post the Viceroy report, because this is what happened with us. The share traded at a discount, and if you guys can't remember this, Viceroy was the company that actually caused the Steinhoff debacle and caused Steinhoff to fall into a heap. So when they wrote this report on Capitec, what happened was the Capitec share price started dropping. And our CIO and CEO, Jacques Conradi, he covers financials, and he's been invested in it personally since 2003. He said, guys, this thing's trading at a massive discount. We need to get in. So numerous guys could do that, and I think other funds did that as well. What we did secondly, and this is unique to hedge fund, is we paired it with another share. We went short. I'm not going to go too big into the intricacies there. Basically what happens is it's almost like a Chinese guy. You sell it now and you buy it later. What happened was the share that we identified was ABSA. And it's not like that we don't like ABSA. It's not that we don't want to bank there. There was just some writing on the wall that said they were losing clients. There was a pending Barclays exit. So there were, let's say, funny stuff going around with the share price, and it started moving down. And at the start, it added us about 20%, and it took out a bit of volatility in our Capitec long position. And in the end, once Capitec started running, we sat in a situation where it gave us about 40% on Capitec, but because of the ABSA share price that fell, we added an extra 20%. So the position was seen as a 60% return.
Yeah, quite remarkable. And, just touching on ABSA, maybe then the share price was dropping, but I mean, ABSA is doing quite well now. And I look at it from a running point of view, being a running coach as well. And we just had the ABSA Run Your City race in the city
GQ,
not too long ago. And I think the whole countrywide, that series is sold out. So it's one of the most popular events. So, yeah, positives to ABSA on that front. But let's talk about now, Andrew. Waldo said, so we had a long position, we had a short position, took out a little bit of volatility. And that's what we are looking for in our client portfolios, is to try and have a diversified portfolio where we have less volatility, which reduces sequence of return risk. We've spoken about this on episode 2, how much is enough. We'll obviously cover it again in the future, but that's incredibly important for people who are in retirement and drawing income. Perhaps you can elaborate.
Yeah, so I think the key thing, Alec, one step backwards is we most definitely not fund managers and fund pickers. So also we're looking at the end of the day to blend certain solutions. But we've got a Cat 2 business within private wealth management that helps us with that. But the key thing, like you say, is we're looking to reduce volatility. When you're drawing an income, a client needs a real return or a return above inflation of, say, 4%. And the key thing is you need exposure to growth assets, right? But when you're partnering with a hedge fund manager like Peregrine Capital, they can give us exposure to growth assets. We can get those inflation-beating returns that our clients need, but they're minimizing that downside participation. So there's a whole lot less volatility. And obviously feeding back into sequence of return risk, the thing is when you're drawing an income every month, you're selling units, okay? And if you're reducing volatility and in downturns that like we're currently experiencing with the Middle East crisis, hopefully that unit price is not decreasing as much because we have exposure, for example, to a hedge fund manager. So the client is selling less units and they have more units to participate in the upside or the recovery of the market. So it is quite technical, but I think a key thing with regards to, like you said, with hedge funds is it helps us manage volatility and it ensures that clients stay committed to their long-term investment strategy, Alec.
And let's also then touch on the fact is with hedge funds, you have different, call it risk profiles, not that we use risk profiling, but you have the high growth fund, which we'll touch on a little bit later, but you also have the pure growth fund, which is a more conservative portfolio.
It's actually a pure hedge, Alec.
Pure hedge, sorry. Hedge growing. Yeah. So the pure hedge fund, so if we take that fund as an example, that was launched in 1998. So we're talking 28 years of history. And it has never had a calendar year negative. And perhaps you can elaborate on all of the sort of crises that has been encountered by this fund.
Yeah, I think the history of Peregrine actually started there, and this is actually the nice part of it. So our company was started with Dave Fraser and Clive Nates, and we got money to start managing the first hedge fund in SA, and that was the pure hedge one. And as they started, it was the Asian crisis. So the market started going down, and over the 28 years, the pure hedge has seen the Asian crisis, it's seen the IT bubble go, it's seen the European debt, it's seen the subprime crisis, it's seen Renegade, it's seen Steinhoff, it's seen COVID, and it's seen Donald Trump numerous times. So, and yes, 28 years are no negative calendar years. And I think just to get into the nuance of the fund, the nice thing is it runs at a low volatility, and it aims to give you, let's say, 10 to 12% per annum, and it's hit that. And that's the nice thing is, it's kind of boring. I think when it comes to cars, you think of it kind of the Toyota Corolla, like the one that my brother-in-law drives. It's from 2003, and the engine light's still on, but it still goes. And that's the thing is, look, the pure hedge's engine light isn't on. So just to say that,
we hope not, Waldo.
Yeah, no, it would have been terrible if that happened. But yeah, so that's where it actually starts coming from. It runs at an equity exposure currently, let's say between 10 and 20, and that's usually where it runs at. And for any client that is very scared about sequencing risk and that is actually, let's say, concerned about market drawdowns, it's a very good fund to have as part of your quiver. And I think that's where you guys come in. Like when we started chatting about it, Alec, our first conversations was living annuity guys that were drawing too much, living annuity guys that were sitting with, let's say, they were almost on the cusp of starting to draw too quickly into their capital. And this is where the hedge funds came in, where it added a bit more surety on a boring kind of side of things. And I think people always they've got this perception that hedge funds fly high. It's more the Lamborghinis than the Volvos. We're safe cars. We're the guys for your family. It's not the James Bond villain car, which is how it's perceived in the market.
And Waldo, just speaking to that point, the normal man on the street can now access a hedge fund. So we're speaking about pure hedge, for example. But if you look at the hedge fund industry in general, right? So a lot of our listeners, viewers, clients know about the long-only space. So a normal balanced fund or a SA multi-asset low equity fund. Do you mind just unpacking the different ASISA categories? Once again, let's not get too technical, but what are the types of hedge funds out there in the industry? You've spoken to Pure Hedge. We do know you have another solution called High Growth. But when clients, listeners, viewers are having a look, doing their own research, what are the types of hedge funds that are available out there in the market?
So Andrew, like the pure hedge is actually called the market neutral. So it needs to have a beta close to 0 because that's what it says on the label, market neutral. If you buy
Can I ask you just to explain, we got a lot of people out there who will not understand what is beta.
If you've got a beta of 1, it means you move as the market moves. So if the JSE goes up 1%, you actually go up 1%. If you've got a beta of 0, you're not associated to what the JSE does, and that's actually where it comes from. So
uncorrelated, which is very important,
Yeah, it's that thing that you guys do. It's like you add a bit of diversity in it.
Yeah.
So yeah, that's what the market neutral strategy of us does. A high growth fund is what you call a multi-strategy fund. And if you look at the underlying asset classes, it actually resembles a balanced fund quite nicely. There's bonds, there's preference shares, there's property, there's equity. And I've once had this question like, do you guys own guns, tobacco, what's the other one? Oh, gambling and finance shares, because it was a question from a client that was concerned about it. And I said, yes, but in 3 days' time, we might not have those shares. So we are quite agile. But yes, the multi-strat, that's what happens. And also for the clients that want to ask, half of the equities that we've got at the moment is actually offshore. So we're not constrained purely and solely towards SA. That's the other thing. Then you get long-short hedge funds. And what they do is they're actually more equity buyers. So you'll find more shares in it, not a lot, let's say, cash and bonds. And they go long and short on shares. In general, they have higher volatilities. So that doesn't really speak towards, let's say, the boring nature of what we're actually discussing now. But that's where it gets funny. Hedge fund classifications can be also misleading, where you get multi-strat funds that are very volatile. And
fixed income solutions, for example,
yes.
as of Waldo. That's where Alec and I have learned a lot, that you see a fixed income solution. And naturally, we as financial planners, when we started engaging with hedge fund managers, you think fixed income, it's more conservative, more a back foot player, maybe a Hashim Amla. But then when you start engaging with the managers, some of these fixed income managers are targeting like CPI plus 6, 7, and 8. And Alec and I were like taken aback. This is a fixed income manager. But because it's in the hedge fund space, what we used to on the label is not what you're going to experience in the tin.
And I think that's actually a common, let's say, misperception that goes around in the industry. Because if you think fixed income, if you think cash, if you think bonds, that's my 0 to 1 year or 0 to 2 year cash that's sitting there. So it's safe as houses. And now if you go into hedge fund classification, it's completely different. So yeah, and I'll get back to like the crux of this thing is we need to work on the education in terms of this industry, that you guys are equipped to actually sell the funds correctly. And I think that's why we spend so much time together with PWM and myself, the both of you, where we can find ourselves where you guys know the products and where they slot in. So you're not buying a can of Coke and drinking cream soda. You actually know what's on the tin and it actually delivers what's there. I think if we move into what's another thing that might scare, like if I speak to my mom about this, she'll be like, oh, but I watched Wolf of Wall Street. Actually, she didn't watch Wolf of Wall Street. I'm quite glad about that. But let's say you take a boiler room example or Wall Street, where hedge fund managers are seen as guys with private jets. They're seen as guys that does dodgy deals. And that's an American misconception. I think what you find in our firm is there's more than 4 actuaries and CEOs running the funds. These guys luckily look at your shoes when they're talking to you. So you almost find guys that they live and breathe these funds. They live in front of a PC. That's what they're there for. They spend all their time there. So it's not this wild, racy kind of gambling perception that is out there in Hollywood. South Africa is the strictest, let's say mostly aggressive, regulated hedge fund industry in the world.
Since 2015, hey, Waldo. So we were speaking in, obviously preparing for the podcast today, how well regulated the industry is. And like Alec, you said earlier, we don't want to go into the compliance aspect, but I think it's very important for our listeners and viewers to know that since about 2015, Waldo, this industry in South Africa specifically has just been so well and highly regulated. It's also regulated by the CISCA Act. I don't want to unpack that in too much detail, but that's the same act that governs long-only unit trusts in South Africa. So once again, just to put everyone's mind at ease, this is not a big black hole. It's super well regulated in South Africa, and we're really comfortable with these solutions.
I think the important thing is that probably the financial planning industry is the most highly regulated in South Africa, and the compliance is top-notch. And then when you look at hedge funds, it is the most highly regulated of all of the spheres within financial planning. So that's also very important. I just want to go back to, let's go to another example. When there are opportunities out there, when would Peregrine be looking at opportunities? I think of probably a very unique deal was the Steinhoff deal. When everybody else was running for the hills, Peregrine seemed to be having a closer look at Steinhoff and opportunities. Perhaps you can elaborate.
Yeah, well, that's actually something that we call as a special situation. And what happened with Steinhoff is obviously anybody on the street knows that the share price basically went to zero. Lots of money was lost, and they had pref shares that was attributed to Pep and Ackermans. And we bought this at, let's say...
Just pause. Let's just unwrap a quick pref share for our clients as well, our listeners. Yeah.
Okay, so a pref share is as a normal share that you get, but this one pays out a fixed percentage on its value.
And the first pref shareholder is the first person paid ahead of creditors and normal shareholders.
Yeah,
so there's virtually no risk. Yeah.
Always a bit of risk, but let's say virtually
Yeah.
no. So what happens then is we bought this, and the reason why we bought the pref shares is because we could see the underlying companies that actually pays the dividend out. And that's where it gets interesting, because we bought this at a massive discount, but we received a running yield the entire time. And we did about 15 times our position there. So that's a good example of something that's very unique to hedge fund that what we can do. Another example that I can say, and this happened in 2022, is we bought Tungela at a PE of 1. A PE is it's a factor that tells you how long you have to wait to get your money back. So if you've got a PE of 1, it means you get paid your whole share price that you paid for. Let's say you paid 10 Rand, it means you get 10 Rand back in dividends the next year or in earnings.
So that's price to earnings ratio.
Yes.
Yeah?
Getting your money off the table. In effect, de-risking yourself.
So we bought in there, and that share price, basically, I think it went from 30 Rand to something like 360 Rand in 1 year. So that's also a special situation, but that is more investment technique. A long only fund could have also done that. But I'm just speaking to the way that we analyze and we saw, okay, listen, this is the way that we could buy in. And what I also enjoyed about all our positions where we go for a special situation is our investment team are heavily connected to that position. So like I'll use the Tungela one. We sat with the management almost every 2 weeks, and we sat with Transnet also almost like on a monthly basis, just to figure out, listen, can you guys get the coal to the harbour? And then we can export it. There was a great offshore demand for coal, and this is actually what created it. So yes, that's the kind of way a special situation arises. And as mentioned, let's rewind back to Steinhoff. Usually it's the bad boy in the market that creates opportunity, because once there's big losses, there's numerous things that fall out and we could actually jump on it.
Yeah, excellent. So there are some great examples, and Andrew, perhaps we can talk about how have we started using hedge funds within our client portfolios. We touched on it a bit earlier, so try and reduce volatility. Protection on the downside is massive within hedge funds. Do you want to elaborate on that?
Yeah, so I think the key thing there, Alec, is all about investor education, right? So investor education, we focus on that with our clients. We take our clients through at least one meeting where we explain to clients the process. Plain and simply, we start in the long-only space and then we move into hedge funds. We don't allocate money to hedge funds for all our clients, Alec. I think the key thing in the post-retirement space, we do allocate a certain amount to hedge funds. I think the key thing there is also how much you allocate. And Waldo, we've had many discussions about this. So you've got to move the needle, but how much do you want to move the needle? And when we mean moving the needle is, in our opinion, you can't just allocate like 5% to a hedge fund. Alec, you need to allocate a sizable amount, should I say. You need a meaningful position within a client's portfolio. And maybe, Waldo, we should unpack that in a little bit of detail, right? And I think we might not agree on the specific percentage, but the key thing to note is that between Alec and I, we're looking at about 20 to 30%. With some clients, we're allocating a little bit more. We might not necessarily allocate just, for example, to Peregrine Capital. Waldo, you are well aware that we've partnered with other managers. We also have a fund of funds solution, Alec, that we are starting to use, which actually includes the Peregrine High Growth portfolio too, Waldo. So maybe just to put you on the spot, throw the question back to you is, in your opinion, I know you've done a lot of back testing, and we've had some healthy arguments and conversations around this, is what is kind of the percentage that you would like to see as an investment manager? And then we can discuss that point and that percentage and amount in this forum.
Yeah, I think when you like move back into it, let's start off with the client because this is what this is actually about. So you use the hedge fund as a tool, and it's part of a package that you create for the client in terms of what his needs are. So let's use the sequencing risk example. So some clients may even end up with 60% allocated towards hedge funds, not Peregrine Capital. So that's the first thing, because then you're putting too many eggs in one basket. So let's say what I found in the industry norm and standard where we've moved towards was actually between, let's say, 15 and 30%, where it makes a meaningful difference. But remember, I'm very biased, so I've got 100% of my money in there. Like my wife's got 100% of her money in there, my mom as well. But that's the way that we work around with it. I think when you start having a look with how these allocations work, it's actually better to know why you're doing it and not just saying, okay, I'm using 5 hedge funds and adding it in. And I think that's where you guys are at. You're saying, okay, we're using it for lower vol, downside protection, and boring kind
The
of
value
returns.
add, right?
Yes.
The key value add.
And that's about the education drive there. Because sometimes, and I think this is where the common misperception actually comes from, is if you have a look at, let's say, a US hedge fund that's got a massive gross exposure, that'll never be used for that need. It might need to be used for something completely different, like long-term growth. Because think about this, like your high growth fund, if it averages 15% per annum, you're doubling your money almost every 3 to 5 years. So that's actually a very nice thing to have. And if you've got that bucket and you are addressing, let's say, certain shortcomings in the client portfolio, that's where the allocation comes in.
And the one free lunch in investing is diversification. Okay, and Alec and I are very firm on that. And it's also nice for you to have brought in the rule of 72. Alec and I unpacked the rule of 72, and I think our first podcast, Alec. But yeah, it's about diversification, blending different managers and investment styles. But the key thing for Alec and I is obviously partnering with managers that private wealth management have done their due diligence on. And the key thing, Alec, and I'll bring you into the conversation here, is we want to get clients over that finish line. And like you said, rightly so, with a lot of your clients, you might have been or have exited the industry. But the key thing is you're already seeing clients into retirement, helping them successfully retire. And then a lot of clients are, it doesn't matter on their age. It's not if they're 75 that a hedge fund is not appropriate. For example, Waldo, you spoke about the pure hedge fund. That might be a great solution for a client that's in, for example, their 70s or even their 80s. Alec, what's your view on that?
Yeah, well, I think the important thing is, our last episode we spoke about, how much is enough. And we spoke about the high drawdown rates in the industry. So if a person's got a living annuity, the average is probably 7% on the total amount of capital or the total amount of living annuities and so forth. And probably, when you start taking out the big ones and you just look at it per capital, you're looking at it closer to 9%. So if you're drawing 7 or 9% and you're only getting 9% growth, there's no room for escalations going forward. So that's a risk. So you have to look at, right, how do we structure a portfolio where we can seek a little bit more growth? And this is one of the reasons that we actually brought hedge funds into the living annuity space, is to target a little bit more growth, but not taking on more risk. Mm-hmm. For example, if you take the pure hedge, it's probably very similar in terms of volatility to a stable fund. But over 15 years, it's probably giving you anything from 2, 3, 4% more. If you take the high growth fund, probably similar, volatility to the balanced fund industry, but over 15 years, giving you 3 or 4%, maybe even more per annum. That's significant. And I highlighted that research by Yaku at 91, where he spoke about if volatility increases from 8 to 15% in your portfolio, your risk of failure increases fourfold. So we have to keep the volatility down. And strangely enough, hedge funds help us to reduce volatility within portfolios.
And that's the key thing that we're focusing on, Alec and Waldo. I think obviously past returns are not a guarantee, obviously, of future returns. And the key thing for us is that we're looking to manage that downside risk, manage that volatility. But also now, Waldo, to bring you back into the conversation, we've spoken about, call it the more institutional side of hedge funds, which is known as QIFs. Okay, the investment funds and hedge funds that we are dealing with on a day-to-day basis are known as retail hedge funds. The acronym is RIFs. How do listeners, viewers, and our clients, via us as Alec and myself as financial planners, actually access these retail hedge funds? How easy is it to access the hedge funds? Are they daily priced? Are they liquid? Or they lockups, etc.? If you can just unpack that in a little bit more detail.
Yeah, I think let's address everything. Like, there's no penalties to exit, first of all. Then it trades daily. So that's what a retail hedge fund does. Qualified hedge funds trades monthly. Ours does. Back in the day, you had funds that traded yearly, maybe only twice yearly, biannual trading. So it was a pseudo lock-in period where clients had to give notice. And like now with the qualified funds, you need to give calendar months notice. And the only way to access those funds are actually directly via us. So it seems like it's admin. And I think that's where you guys kick in, where when a client approaches you, you can say, listen, I've seen Peregrine in the media, if I read something on MoneyWeb, I want some money in this fund. And you can be like, okay, here's a quote, here's all the LISPs that it's available on. The minimum is a lot less because it's dependent on what the LISP says, and you can get your money depending on which bank you are quite quickly.
Yeah, the key thing from a liquidity point of view with retail hedge funds, your money, for example, if you're in a unit trust investment, the money could be paid, like you say, into your bank account within 5 to 7 working days via a platform. If we access the hedge fund, the retail hedge fund directly, which Alec and I can, for example, directly via what we call a Manco, it could be 3 to 4 working days. But Waldo, also you spoke about MoneyWeb. I'm just going to give you a little bit of a shout out. Alec and I stumbled across an article that you wrote on MoneyWeb yesterday, speaking about some portable alpha. We're not going to go into those technicalities today. But yeah, I think the key thing, and Alec and I are always speaking about this, Alec, is that our industry is always evolving, and we really are trying to stay ahead of the curve, at the cutting edge, and things are moving really, really quickly. And the size of the industry, if you think, Waldo, globally, I was reading some information that the hedge fund industry currently sitting at about $5 trillion US. The local hedge fund industry is sitting at about, call it 200 to 220 billion rand. And the key thing that Alec and I have also done some research on is there's some massive universities, specifically in the US, okay, where there's a lot of data available, the likes of Princeton, Alec, and please step in here, Yale, Stanford, etc., that have got, call it like 30% of their endowment fund or trust fund invested in hedge funds. Now, if you've got these really bright people and individuals making use of hedge funds, I think, Alec, for me, that's why when the penny like really dropped, right, I like sat back and I thought, saw about it. I saw this graphic and I was like, wow, right? It's not taking things for granted, but if these people and individuals that are really smart have been investing in hedge funds for years, why are we not doing it?
So strange that you mention that, because back in the early 90s, I was doing the fundraising and marketing for the Grey Schools in Port Elizabeth here. And I went overseas, actually set up the Old Grey branch in America. We also set up a tax trust there where any American can donate to the Grey Schools right here in Port Elizabeth and get a tax deduction. But one of my key things that I had to do was to visit some of those top universities and some of the top schools. And it's quite amazing, you talk about those endowment funds, and I was exposed to that and so forth. But what they do is 60% of their budget is run according to the actuaries. It's the legacy project. So they don't ask their alumni to donate now. They say, can you include us in your will? And those actuaries work out exactly, and they've never been more than 3% out. 60% of those universities, very often, their budget is run from the legacy project. And they use these big endowments and so forth, exposure to hedge funds and things. So it was actually quite nice to visit and broaden one's horizon already way back then, 30 odd years ago, about, the magnitude of things. Everything's bigger in America. I won't say better these days. Back in the days, we used to say bigger and better in America, but certainly bigger. So it's quite amazing to see, what's out there in the world as well.
Yeah, like I think about how these inclusions work, and obviously the US is a bit of a harbinger in terms of what happens in the industry. Regulation-wise, we always say like England does it, and then we just mimic them. But all the investment products that we are seeing are actually like usually started in the US. If you think about the ETFs, the passive funds, largest asset managers in the world manage passive funds. It's BlackRock and Threadneedle. So you sit in a situation where you can see what the US does. And these large university endowments have obviously spent time with a lot of these hedge fund managers because all of them studied there as well. And if you move into the the SA sphere, we've had institutional investors in the past, and we've explored numerous offshore guys as well. Like, think about it this way: the Norwegian Sovereign Wealth Fund has invested in numerous hedge funds, not just in the US. So it is an appealing product, but it also comes with a ton of bells and whistles because it's large institutions. What I do find now, and what we actually, this is what our approach was, is we said we'd rather work with guys that we work with closely. So yes, these guys sit in a situation where they say, we can give you 30% of what we have in our endowment. These are the regulations, and then you adhere to them. But it's not just them. Remember, pension funds also do large allocations towards hedge funds. Unfortunately, in SA, because of Regulation 28, we're quite limited. Let's not start on that one. Otherwise, my IRA would have been also 100%.
But maybe we can just touch on that for people who've got a retirement GOT, and obviously one is constrained with the type of returns you can get by Regulation 28. The government limits you in terms of how much equities you can have, how much offshore exposure. They also limit you in terms of hedge funds. But there's an opportunity that I believe that 90+% of people in retirement GOTs are missing. They can get up to 10% exposure to hedge funds in their retirement GOT. And I would encourage people to go and visit their financial planner, broker, advisor and say, can I get exposure to hedge funds in my retirement GOT? Again, more diversification, seeking more growth, probably reducing volatility, all positives. So it might be a small percentage, but 10% is a lot better than nothing.
Yeah, Alec, and the personal hope that I have is, like both of you know, the offshore limits back in the day, I think, was 15%, if I'm not mistaken. We're sitting at 45 now. And my hope is that the regulator actually increases the hedge fund allocation as well. So hopefully R10 can also go up to a 45% at a later stage. And I think that's when it'll only happen. Once again, it's only my personal view, is once there's trust in the industry. Something that I do want to touch on in terms of the trust, we're FSCA approved. So you guys can invest in us. And a lot of the sad stories that we've seen in the past in SA are people losing money in investment products that promise great returns, and there's always one common denominator: it's never FSCA approved. And there's sad cases, you guys know this. Unfortunately, clients that draw too much income, or clients that don't have money at retirement, gamble and they put money in these products on promises, and unfortunately it always ends up in a sad way.
Well, we think of close to Port Elizabeth, we had the Maureen Clifford debacle. We had AJ Brown at Fidentia.
And we're actually speaking about this just yesterday.
Yeah. So it's important that people realize, and I mean, I was relating yesterday to a client that back in 2008, a client I was introduced to, became a client, had sold a property in Llandudno and had 8 million rand to invest, and was very nervous about investing this money. Where's my money going to be? What are the regulations? And I went through the whole detail, and this is where the money needs to go to, and so forth. And the next day, our receptionist phoned me and said, Alec, I've got a check here made out to you for 8 million rand. But the client, he was an elderly client, and he'd forgotten what he'd asked and just thought, you must give me the check. Fortunately, it wasn't made out to Maureen Clifford. Otherwise, maybe the 8 million rand would be gone.
Would have disappeared, most definitely.
So I had to go back and get the check reissued. And I didn't shoot off to Mauritius. Imagine what 8 million rand would be worth today.
Jeepers. Yeah, I don't know. Like, I can't do the maths now.
A substantial amount of money.
But it's important, that that trust factor, working through, people who are FSCA compliant, working through accredited advisors. Not only us, not only private wealth management, as we said last episode as well. We encourage clients to go and see, people who are qualified in the industry. And get professional advice, because it can help a great deal. I just want to touch on a little bit something we haven't touched on, is the the toolkit. So let's talk about with hedge funds. So normally you would have, let's say, a balance fund. There's many balance funds out there: Allan Gray balance fund, PWM balance fund, Coronation balance fund, etc. Now, essentially, those fund managers are what we call long only. They need the market to go up for the clients and their funds to benefit. Within a hedge fund, there are more tools available, and you can perhaps elaborate.
Yeah, so obviously we can also go long. So we, as mentioned in the Capitec example, you can just buy a share and go long and make money out of it. What the hedge funds actually bring to the table is, instead of only being a steak knife, you've got a Swiss Army knife. So you can do short selling, where you sell a share now at a high price, and once it falls to a lower price, you buy it back, so you make the profit almost backwards. So that's
the inverse of going long.
Yes.
So you can make money if the market goes up, but also if the market goes down, and that's simply how I position it with clients. So Alec,
and I think the important thing is you're relying on the performance analyst, right? And if they're good at their job, you're going to do well. With a balance fund, and not knocking balance funds, they're great products and we utilize them. But there you can have the best fund manager in the world, but if there is a geopolitical event or some risk or something, he has no control over that.
Performance is out of their hands.
Yeah.
Yeah, and I think if you touch on to something else that we can bring to the table, it's called a put option, or actually just options. And it's the easiest way to explain is the right to participate in either up or downside. So if you want to participate into the upside, it's called the call option. If you want to participate into the downside, it's called the put option. And what that means is, if the market goes down, you've got a form of a pseudo insurance policy there on your money.
Perhaps you can just mention, I seem to remember COVID, there was a great example you can bring in about that.
Yeah, look, if you have a view of 2020 and our fund performances, the high growth did about 17, Pure Hedge did about 12, JSE did 0.6. But that doesn't tell the real story. First 3 months of 2020, three of us know, everybody that's listening, everybody experienced that. So the market started dropping. And then what happened is our PMs, portfolio managers, realized that, guys, the COVID lockdowns are going to be imposed everywhere. And they decided over a weekend in Feb, let's take out a put option on the S&P 500. Let's help our portfolios. And then March 2020, the JSE dropped 17%. The high growth, I think, was down 1%, and the period was actually up a bit. Sure. So we mitigated that risk.
So that's the downside protection we spoke about earlier.
The volatility,
Yeah, look, it's not a silver bullet, guys. And I think this is the big thing, where it's always great hearing the good stories. But this is what we can do and where it has helped. A good example is we've had call options on the JSE, like post 2024. So GNU was announced, JSE started running. So we could participate in that. So that's a very nice thing to have as an arrow in your quiver. So we can do more with what goes on in the market, and we've done it. We've got a track record with it. So it's always fun to say, okay, we can do all these things, but have you actually done it? And I can actually say with honesty, yes, we have.
I think the important thing here is we're having a lot of fun talking about something we're passionate about, and time flies when you're having fun. And so we could talk about this all day.
I've got one more burning issue.
Right, so hit the burning issue and then we're going to wrap up.
Sorry to butt in, but I think the key thing, you former financial planner of the year, 2009. We've got Mr. Bruce Fleming sitting in Cape Town. I think he was former financial planner of the year in 2016. We've got a couple of finalists up in Pretoria, Francois Leroux. We're fully transparent on this show. I know we're going to get some questions on this. Fees and performance fees. Alec and I are very comfortable in positioning our fee as a financial planner, and we're also very comfortable in positioning the performance fee that is charged by hedge fund managers. But in a minute or so, please, Waldo, if you could just unpack performance fees and the performance fees that are charged by hedge fund managers, and then Alec and I will just step in and say this is the way we position it to our clients.
Okay, what I'll use is what's actually going on, let's say, in the media. And if you watch, let's say you watch Billions, they always talk about a 2 and 20.
Yes.
So you pay 2% per annum, and then a performance fee gets charged of 20%.
On top of that.
Yes, but we don't charge that much, fortunately. So high growth, I'm going to use as a good example. It costs you 1.73% per annum to invest in the fund.
And that's the annual management fee,
That is the annual management fee. Look, there's numerous other charges, but I'll skip past that. I just want to get into the performance fees.
Perfect.
We calculate it on a quarterly basis, where we crystallize on what you call a NAV value. To make it simple is, if you start climbing steps, you can only pay yourself once we've exceeded the highest step that we were on. So in all instances, clients will always receive 80% of the outperformance that we've given to them. In most instances, they actually receive a bit more, because remember, funds go up and down. So that's the way that it works. And I think the misconception in the market is, if you have a look at what the EIC or TIC is on an MDD, you look at the 7 or 8%, let's round it down to 5. And clients think, okay, am I paying 5% now to enter into the fund? That is not the case. So if you enter in our fund now, it's going to cost you 1.73, and all the performance that you are receiving, you're going to get at least 80% of. And remember, the EIC is calculated, TIC is calculated backwards looking. So let's say you had one for over the last 3 years of 7% and performance fees was 3. That means it was 20% of the outperformance. I'm rounding down a lot, so don't shoot me over the bad maths here. But the idea is clients always receive better, they receive 80%, we receive 20%. So we incentivize to actually give them proper growth.
Yeah, and I think the key thing, Waldo and Alec, there's a lot of noise around fees in general in our industry. Okay, you've just been fully transparent. We're not going to go into the 12th decimal here, but the key thing is we've raised the point on the show. Okay, our viewers, our listeners, our clients, like you spoke about the EAC. So it's called an EAC of 3%. That's what the client's paying. I'm just throwing a number out there. But we disclose that in every single meeting, Alec. I shouldn't say every single, but every single record of advice, every set of minutes that go out, every set of minutes that your PA Nikki types. I use Copilot for my minutes. The key thing is that we explain every single fee that our client is paying, and our clients are comfortable with that, Waldo. And that's the key thing out there in the industry. You go onto LinkedIn, there's certain comments, posts, and there's a lot of comments from other financial planners. The key thing that it boils down to is understanding your value add, what we are trying to achieve with our clients, trying to get them over the line, what we are trying to achieve here with this podcast. We are informing people. We don't hide anything. There's full disclosure. But maybe just in closing, Alec,
I
from
just
your
want
side.
to add to that, sorry. So if you take, a year or two ago, the Peregrine High Growth funded, I think, 22% for clients. So let's just call it 20. So they would have done 25 gross, kept 20%, and given the client 20. I had a discussion yesterday with a client, a former EP rugby player, and we were talking about this, and he said, "Let's, if we get 20%, I'm happy to give 4% away, 100%, and receive 16." The point of the matter is, I always say this: I would rather have 80% of a lot than 100% of a little. And generally hedge funds have, and as I say, it's not always going to be like that. But if we take over a 10-year period, the law of averages and whatever the case is, you are going to get some great performance, some reduced volatility, and protection on the downside. I see a lot of benefits to it. I've probably 100 clients in hedge funds. They're not worried about giving away 20% of the performance. Yes, we would like the performance fee to reduce. So, Waldo, let us know when that's going to happen. And I think it's also important for people to understand, us as financial planners, we do not participate in that performance fee. No. There is no rebate or kickback or whatever. We get nothing. The only thing that us as financial planners or private wealth management get is the financial planning fee that we discuss and disclose and negotiate with clients.
And just to add to that point, Alec, we have a team at Private Wealth Management that are engaging at, call it, an institutional level with the likes of Waldo's team at Peregrine Capital with regards to performance fees, performance in general. I also spoke about that hedge fund of funds that we use. It's all about scale. But the key thing is that we are always engaging. We are always having constructive conversations, and we're always monitoring the space, be it performance, be it fees, to ensure that our clients are getting a appropriate and suitable solution.
Guys, if I could just jump in there, I think it's about merited inclusion, let's be honest. That's why I'm sitting here, and that's why we've got a relationship. But something that's never mentioned about MDDs, and I get these questions, and you think, like, why am I getting this? But let's say it. Performance that you see on the MDD is always post-fees. It's
So
net
just
of fees.
explain MDD for those
It's
who
the
don't.
minimum disclosure document.
Yeah,
So
fact sheet.
Yeah, it's the fact sheet. Like, you get one every month. You'll get a high growth one. You get a pure hedge one. You guys receive it. And then you can see, okay, let's say the fund did 20%. Remember, the 20% is after the fees. So you don't have to go and look at the fee and deduct it again. Because sometimes it's confusing.
So every presentation we have, we only use the net fee in our
Net
presentation,
return,
in our
you mean,
net return. Yeah, our net return. Folks, I think we're going to wrap up there. This has been a really entertaining session for us, maybe a bit complex for some of our listeners and viewers. But I'd like to encourage, all of you out there, if you do have any questions, if you want us to elaborate on anything, you're welcome to drop a comment on Spotify, Apple, or YouTube. Please don't forget to like and subscribe, because we want to try and grow this podcast. We're passionate about this becoming a much sought after podcast, and we want to try and educate the hundreds and thousands of or millions of people out there who are looking to try and understand financial planning a little bit better. And you can help others by helping us to grow this platform. So thanks very much. Waldo, thanks very much for your participation. We appreciate it.
Thank you, Alec.
And Andrew, once again, thanks. And our next episode is going to be a Q&A session where we've got a whole lot of questions that we are going to ask, covering a variety of topics. And so make sure you get your question in, and in the future we might be utilizing some of your questions. Thanks very much.